Another record-breaking day for the Dow. It closed above 40,000 for the very first time in history. Here to share where she is finding opportunity in this market is Olaolu Aganga, Mercer's U.S. Chief Investment Officer. Always great to have you, Olaolu. Thanks for coming in.
Thank you for having me back.
So, I mean, your clients aren't really focused on the Dow, though, are they?
No, not usually. I've been here a few times. We are very much focused on the long term. I'll talk about value growth just quickly because we mentioned that. Those are factors that alternate somewhat frequently, except in the last 15 years where we've seen low rates. So growth has been the clear driver. But now in this environment, we're seeing it flip. So what value's been outperforming since February, and now Dow where it is, right? A lot of these names are value. But our clients, as we mentioned, are longer term type of investors. From a strategic standpoint, it's always been alternatives. I feel like I'm coming and saying alternatives. But we issue surveys to be able to get a sense for where clients are looking and trends. It's called a large asset owner survey. So some of the directives show that it has been the private equity, the private credit, but then also at Mercer, our platform sees the flows.
Okay.
So we're able to see where clients are allocating. So our private investment platform, for example, the last fund was about $4 billion, and it was across a number of those areas. So we're seeing clients telling us that where they're looking for opportunities, and then we're also seeing the flows as evidenced by some of our funds.
How much of that, based on the headlines and just what the market did last year, you think is fear and a desire for capital preservation and a little bit more, I don't want to say of a sure thing, but a sense that, okay, in alts, maybe I can be less exposed to the vagaries of valuations in the public market? Valuations,
the mark-to-market, all of that. So usually when you have alternatives in the portfolio, it's hard to think about it this way, but you would think it would be more volatile, more risky. But because it is marked so slowly, it actually brings the stability that you need. So the asset owner survey is one way we're looking at it. Other clients for themselves, if they're like, okay, this may be hard to do. We're also seeing trends in outsourcing. I think there were some headlines for big institutions outsourcing as well. We see that. We're a beneficiary of that at Mercer. So it may seem scary, but it really isn't.
So on the other side of long-term, perhaps Europe, right? It's been underperforming the U.S. for a long time now. And we had somebody else saying this earlier this week. Is it time to look more closely at Europe again, even given what we've seen happen with Russia, Ukraine, and everything else?
So strategically, we've been neutral. So the strategic is the long-term asset allocation. We've been more neutral. Tactically, though, we've been looking internationally. But I think I've been talking about China. And, when you have valuation distortions that are that wide, it's 3 years of underperformance in that particular market, those are where we're starting to see, and we've seen it recently, some of the outperformance. So we're watching some of the other areas, but we tend to not move as fast. There needs to be more data points to support it.
How do you think about China in the long term, though, given that in the near term, in an election year, nobody loses points for looking tough on China, right?
Yes.
So does that create buying opportunities that you see long term? Are you thinking about it that way, or does it highlight dangers in getting too bullish long term on China?
Yeah, so I'll say two things there. Usually with elections, we see volatility. Across the board, it doesn't matter which country, which region, it's volatility, but it's shorter term. So it happens, it's a shock, and then people sort of move past it. So the studies that we've done have seen no lasting impact with regards to elections. But we look at policy actions. Those could be longer term, and we're seeing tariffs and those types of things. So again, the China where we're looking at is tactical, not from a strategic longer term holding. It's the valuations are cheap today, you can insert, but then you should also be mindful that we may need to get out.
What are you doing with India, given that so many demographic trends are moving in India's direction? I
mean, India's been doing really well. So if you were to split up emerging markets to EM ex-China and then China, we've already seen a lot of the outperformance across the board. So Korea, Taiwan, India, Brazil, you name it, like the emerging market countries ex-China has already been doing well. China is the one that's been, from a valuations perspective, really depressed.